Hello everybody, Luke Gromen, founder and president of FFTT, Forest for the Trees. Happy Sunday evening to everybody here in the Eastern time zone of the United States. Hope everyone's had a great weekend. Wanted to join you again really quickly for the two things that grabbed our attention recently. Thanks again to everyone logging on to watch the replay. Great to have you watching and checking in. Really quickly here, two things. The first is that beginning to see a bit more balanced and I think realistic assessment of the China-U.S. trade tensions from both sides. First off, you've seen in the prestige media a number of different articles in the last week to 10 days noting that China has a hand to play, has some cards they can play, and that's a bit of a change. And on the flip side of it, that the United States, which up to this point in most of the U.S. Western media seems to have been operating with all the cards or most of the cards or from a position of overwhelming strength, you're starting to see some sort of rumblings that the U.S. has a bit of a fiscal problem, which some of that might be due to the extraordinarily large August deficit, $214 billion, which did have some one-time numbers in it. But even the normalized number, $150–160 billion, that's still a really big number. So it'll be interesting to see going forward what the narrative, how this shifts. It's one of the things we sort of feel that is less quantitative and more qualitative, kind of touchy-feely, if you will. But we're shifting, it seems like, from a narrative of the U.S. has all the cards, China has none, to maybe a bit more realistic, realpolitik assessment of what's going on. And as we have continued to say all year long, we continue to think that the key crux of these trade tensions are a matter of national security for both China and the U.S. And therefore, these tensions, which people keep calling for an end for, we don't think, unfortunately, are likely to come to such an easy or quick conclusion. So we'll be watching that going forward. The second thing that grabbed our attention recently, and it's kind of a one-off, we don't spend a lot of time talking about Japan, but I saw a headline and story on Zero Hedge recently. It was from a Bank of America Merrill Lynch report where they noted that there was a chart in there that grabbed our attention to show that Japanese land prices are up year over year for the first time since 1991. And first off, anything that hasn't happened since 1991 grabs our attention right off the bat typically. It's not just because back in 1991 I had a full head of hair, in fact, a glorious mullet. But more importantly, in the case of Japan, if they actually have to start seeing, or if they actually start feeling some inflationary impulses, that could have absolutely enormous impacts on the global financial markets, FX markets, bond markets, stock markets. Obviously, the yen has long been a funding currency. It's been a bit of a risk-off currency. If all of a sudden there start to be some inflation/rate, considerations there, or BOJ is forced, that could really be a real bit of a game changer. So one data point, don't want to make too much of it, but like I said, hasn't happened in 27 years. It's always worth making a mental note of. So I'm going to take some questions now. While I'm waiting, just a quick highlight as always. Check on our website, FFTT-LLC.com for updates on what we're up to. You can also find out if you do like these periscopes. You can check out on our webpage how you can get in your inbox every week our tree rings. 10 most interesting things report. It's a nominal subscription fee, so check that out if you do like these. It's 10 most interesting things that we've seen every week, along with a brief synopsis of why we think it's interesting and what it could potentially mean for markets. So with that, I'm going to open up for questions. Let's see here. Thoughts on next rate hike. Should I buy puts or calls on GLD? Next rate hike, I think, is a done deal. If you look at the Fed funds futures, I think the rate hike after that is continuing to be an increased odds. to me, I think about it less in terms of do I buy puts or calls on GLD, and that's a separate discussion in part because of some of the things we've talked about at the gold market. But as it relates to the Fed rate hike program, we're really focused on what's happening to the U.S. economy. We're starting to see, maybe signs of some softening on the housing side. Some of the leading indicators in the Philly Fed, for example, some of the industrial data series may be softening a bit. That's what we're really watching because that really is where the Fed gets put into a bit of a corner. The other thing that has been of interest to us is, as it relates to Fed rate hikes, is the narrative is they're going to raise rates and that's going to force capital back here. There's clearly been evidence of capital moving back here, but that capital was going to bid up the dollar, and it's not happening. Now, it's possible that it's not happening yet. But you've got transatlantic yield spreads are the widest they've been in 30 plus years, and the dollar's fallen the last couple weeks. The dollar's basically back where it was a number of months ago. So that's how we're thinking more about these Fed rate hikes. Let's see. How's the book Raven of Zurich? It is excellent. Would highly recommend it. Hello to Anthony who asked that question. Great book. Really enjoy it, and I think it's very apropos in a number of ways. For those unaware of it, Raven of Zurich is a gentleman named Felix Sommery, who was a banker in Switzerland, and the book was recommended by Jim Rickards in one of his most recent books. But it gives you a real-time, it is a diary. He's keeping notes of his interactions and speeches in between the two world wars, and so he doesn't know a second world war is coming, and so it's very interesting. He doesn't know, and then about halfway through the book, he begins to warn people that it is coming for a number of different reasons. So it's very interesting to see someone that didn't have the benefit of foresight what they were watching, an experienced financier, and unfortunately there are certain things that are rhyming now versus then. Let's say, what is going on with the euro pound putting pressure on the dollar? I'm gonna pass on that one for right now. With the euro pound, to me, I think what's really going on, I think it's less what the euro pound are doing, and I think it's more. I think the U.S. fiscal situation is starting to creep into people's psyches. I think they're starting. When you see a number like a $214 billion deficit in a single month, and I know there were some timing issues, but that's just an enormous number. And it's, like I said, it's timing. Maybe it's a little bigger than recent trend, but that's where this movie's going. And I think when we print numbers that big, even if they're a bit of a bit of one-offs in the near term, they're not one-offs as we look out 2 years, 3 years. And I think this is what Ray Dalio was kind of hinting at. Particularly when there's no foreign central banks buying U.S. Treasury bonds. We're going to have to fund all of that ourselves. And so you look around the U.S., who's got $214 billion a month to spare to pay for baby boomer entitlements and interest expense and a DOD budget. It pretends higher rates, which then in turn puts pressure back on the U.S. economy, makes that $214 billion, $220, $230, $250 billion a month. So that was, I think that's what's more going on with the dollar, is that when you start having luminaries like Ray Dalio, and even, it wasn't highlighted as such like Dalio's because he wasn't as explicit as Dalio, but David Tepper made some comments 2 weeks ago about maybe the tax cuts were ill-timed. He was much more diplomatic about it, but you could kind of hear, shades of what Dalio was saying within that as well. Do I consider placing a bet in the surrounding of gold, for example, mining stocks? Personally, I don't have I have not done the due diligence on different mining stocks, different mining companies, and so I don't talk about those. I think there are some people that do an excellent job with those types of investments. John Hathaway at Tocqueville Fund, I know, has run a very good gold fund for a long time. To me, if you're not going to own the physical, then I think you want to go with professionals out there that really know that space. I have not done the due diligence on the miners, and so I'm just not in a position to comment on those. Let's see. I saw Walmart said it'll raise prices, and they are blaming the tariffs, the inflation narrative turning. I think it's an excellent question. It's from hi Andrew, how are you? A question from on the other side of the world from Andrew. I think it's an excellent question and a key issue when you look at these tariffs, and then tie that back to what I was just saying about the U.S. fiscal situation and the lack of capital flows, the lack of a reaction in U.S. 10-year yields from what has been a pretty pronounced sell-off in some of the weaker parts of emerging market economies. And by that I mean 10-year yields have not fallen; they've actually risen, even though we've had this emerging market problems. If I'm as an investor, if I'm an allocator of large amounts of capital. And by that I mean 20, 50, $100 billion. I'm looking at this trade war a little bit differently probably than just smaller amounts of capital. I'm a whale, right? I'm steering the Titanic, and you can't slalom icebergs, or at least you shouldn't try to slalom icebergs in the Titanic. And so I look at the trade wars and I think, all right, prices probably starting to go up in the U.S. They should on some level factor through on the inflationary side. I know foreign central banks still aren't buying treasuries, and so rates are, all else equal, should move up in the U.S. as the U.S. deficits are moving up. Just doesn't seem like a great environment in which to own treasuries and possibly to own dollars. If I know treasury bond prices have to fall over the next 2, 3, 4 years to make the math work on the U.S. deficit side, to me, I'd rather kind of hold off as a big allocator of capital. Again, I'm talking about whales, hundreds of billions of dollars. I would be more inclined to move, crisis alpha, as I've heard it defined, into U.S. equities versus U.S. Treasuries. And so again, I know it's, we've harped on it a number of times. To us, one of the big metrics for this cycle is the S&P 500 over the TLT, the long bond ETF, and that ratio just keeps rising. It's a new record last week. It's broke out shortly after Trump got elected, and it has just been, and it's likely to continue rising. To us, it's a big gear that both tells us what's happening and is a way to play what's happening. So maybe I'll answer it that way. Any thoughts? Any thoughts on Tesla? Tesla's a very emotional subject. I'm just not deep in the story. I would defer to those. I mean, it seems like I've seen headcount move, and I've seen, I'm on record saying that I've test driven an S and I love the car. I just don't have a great feel for what's going on there. I defer to others. Let's see here. If interest rates, sorry, I missed a question from Jay. Hi, Jay. If interest rates continue to rise, when will it affect the S&P 500? This is another one of these. I think it's a very interesting question. It's a very important question. It's something I rattle around in my bald head quite a bit, which is, normally you would expect interest rates rising to be at some point bad for the S&P for U.S. stocks. Every other cycle in a long time has been that way. That said, it's been 70 plus years since the U.S. has had fiscal problems. And these are very, very big fiscal problems. There's as Alan Greenspan said in 2015, unfortunately, I don't see a way out of this without a crisis. And that crisis is unlikely to look like U.S. crises in the past in our minds. That's what we're wrestling with. What this may look more like, because again, if global central banks aren't buying U.S. Treasury bonds as FX reserves anymore, then U.S. deficits matter for the first time in 70 years. That U.S. has been the only country that's been the case for 70 years. If deficits matter for the U.S., then you have to start looking around at other nations who have fiscal problems. And I'm going to use a couple nations here that are not the right example, but they are extreme so that they're very illustrative. And by that, you look at Venezuela. Venezuela's rates are up, currency's down, stock market's the best performing stock market in the world in nominal terms, by far. Turkey. A classic emerging market crisis. Those are two very extreme ones. I don't think the U.S. is Venezuela or Turkey, to be clear. But I think what we're seeing, possibly to likely, are the early stages of a deficits matter for the first time in 70 years crisis in the U.S. And by that I mean rising rates, not rising dollar, and rising stocks are not necessarily a great sign of, I'm not sure the way to play that this time is, hey, rates are going to hit some magic level and then I need to sell stocks and be in bonds. If you look at what's happening on the fiscal side, it starts to look more like an emerging market crisis with American characteristics, which is where are the level of rates where the Powell put is triggered in the Treasury market, and that point, the Fed has to either back off, they've got to stop shrinking their balance sheet, they have to start growing it again, in which case the move again, that crisis, you don't buy treasuries, you buy stocks. And so that again then ties back to this point on the S&P over TLT, which is again why I think this is both a gauge or a thermometer of what's happening and also a good way to play it. Let's see, do I keep track of oil stats enough to see if Iranian oil is ending up in China? There's a number of good services that are doing that in terms of some of the tanker trackers and what have you. I've been reading the headlines very, very closely and watching the headlines closely and watching data for that. There's two biggies, right? So something we've talked about is and referred to as the State Department oil market, and by that I mean oil markets have the hand of the U.S. State Department in there vis-a-vis these sanctions against Iran, effectively removing oil from their oil from global export markets. That creates a pricing umbrella for U.S. shale and other players in that market. There's the two biggest importers of Iranian oil, as we understand it, are China and India. And so to us, the thing to watch are the headlines, the stories, the data on how much China and and India are going to take of Iranian oil, particularly as we near what I think is an early November deadline for much of that oil being removed from the market if you don't have exemptions. So that I'm watching the headlines. I'm not tracking the data barrel by barrel, but I think it's a very important question as it relates to oil markets and U.S. industrial markets. Andrew, yes, his question was, an Indian central bank just bought some gold. And yeah, there was, the question is for Iranian oil. That is a very interesting coincidence that the Indian central bank just bought just bought gold for the first time in nearly a decade, roughly the same week in which they said that they may not abide entirely by U.S. sanctions on oil. On Iranian oil. We'll see. It's obviously a very delicate situation, but using gold to settle Iranian oil has already been demonstrated through Turkey, involving China, has already been demonstrated to work quite well. It helped break the sanctions the first time around. And of interest is the U.S. State Department call reviewing the sanctions, I think it was back in late May, mentioned gold twice in a brief call talking about what was on the Iranian sanctions, what was not, which, it's probably the first two times the U.S. government has talked about gold on an official basis in 30 or 40 years. And so that would intimate or infer, we could probably infer that there is some level of understanding that, what the Wall Street Journal called was a golden loophole around Iranian sanctions back in 2014. Still exists. There's certainly efforts being made by the U.S. State Department to close that loophole, but it's worth watching. All right, at this point, doesn't look like there's any other questions, so we're going to check out here. Happy Sunday night to everybody else out there. Again, hope you guys have a great week, and look forward to catching up with you next week. Take care, everybody. Have a great night.